Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is a special edition of Market Guru. My guest today is Mr. Aashish Somaiyaa, CEO and Executive Director at Whiteoak Capital Asset Management, a firm which provides investment, management and advisory services. And Whiteoak group of entities collectively have assets under management to the tune of $6.6 billion as of 30th of June 2023. And Mr. Somaiyaa has seen and also been an integral part of the mutual funds industry over the last 23 years odd or so. Before joining Whiteoak, he was also part of Motilal Oswal Asset Management Company, where he led the firm for nearly 8 years as managing director and CEO as well. Welcome, sir. It's a great pleasure to have you with us on Business Today TV. And at a time when the markets have been hitting record highs days after days, it is great pleasure to host you. And you've seen the market's journey for far too long and all the cycles. At this point in time, what exactly is your sentiment about the markets when the Nifty is nearing that 20,000 mark? And is it too good to be true? Are we running ahead of fundamentals? What exactly is the sense that you have about the markets?
So, Sakshi, first of all, thanks a lot for, inviting me and having me on your show. I think, if you really look at it, markets have taken everybody by a bit of a surprise. The reason is clearly because, as recently as March 2023, we were more like 16,700 on the Nifty. And clearly, in the last 3 months, what has changed is that, while our fundamental performance, India's relative performance compared to emerging markets, our, corporate performance, cash flows, all of that has been holding up quite well throughout this challenging period of 2022. What has happened in the last 3-4 months is there is some sign that some of the macro headwinds are probably receding. Whether we look at, say, US, whether we look at commodity prices, whether we look at oil prices and the probable flare up from China reopening. I think a lot of the concerns which were bothering the market last year, they are kind of behind us. And it's maybe an irony, but somehow people are getting used to the war also being prolonged, unfortunately. So whatever was bothering us last year, all those headwinds are kind of receding. And on the other hand, our domestic fundamentals are holding up. So clearly, if you ask me, for 2 years now, October 2021, Nifty was 18,490 odd, November 2022, 18,900 odd. And now we are more like, 19,700. So you can see that for 2 years, it has been in kind of a similar range. While we are making new highs, I don't think anybody can make the case that we are extremely expensive or that we are too stretched. In fact, we've been in the same range for about a couple of years. And in the interim period, EPS has gone up by 25-30%. Corporate performance has held up. So I think we are quite fair at this point in time.
Okay, so what next after Nifty really touches the 20,000 mark? It could be any day. And, the moment we touch that, the big question happens now, what next? So what is your own target for the Nifty? What is your own sense after 20,000?
So, Sakshi, if I see from our viewers' perspective or investors that we deal with and we manage money, I think there is this penchant for reacting to this phrase, which is all-time high. And, for our viewers, I just want to highlight that while right now, say July 2023, we have witnessed an all-time high. The previous all-time high was November 2022. Before that, October 2021, we made an all-time high. Before that, November 2020, we made an all-time high. And before that, January, February 2020 was an all-time high. And before that, January 2018 was an all-time high. So the reason why I'm narrating all of this to you is to just tell you that pretty much every 15 to 18 months on an average, the market makes an all-time high. Yeah. We are in a growth economy, we are in a growth-oriented market. And the fact that it is prone to making such all-time highs is why, equity investing is so rewarding. In terms of what next, I think that, as stock market investors, we have to be probabilistic rather than being deterministic. So at this juncture, if you were to ask me, what is the probability that market keeps going up and what's the probability that market takes a breather? I would say the probability that market takes rest or takes a breather is higher than the probability that market keeps going up another 10-15%. And there are reasons for this. One is because, whatever happened in US, like a continuous spate of rising rates all the way from 0 to now 5.25%. I don't think that we have seen the entire collateral damage. I don't think it's behind us. Maybe the elephant has passed us by, the tail is still likely to bother us a
Okay.
little bit with couple of more rate hikes, etc. So US is not behind us. Sharp rally in 3 months makes market more prone to corrections. And then, 10, 11 months down the line, we have a general election, which also causes people to sometimes pause and say that, okay, let the event pass by and then we will reconsider our positions. So I think if you ask me couple of years out, I would be still bullish and constructive. If you ask me 6 months out, I would say, it's anybody's guess. Very difficult to call.
Okay, so since you mentioned about the Fed rate hikes as well, markets at record highs, whether we see emerging and developed markets, will the Fed rate hike now impact liquidity flows? And what are the risks that perhaps could be lurking under the surface then?
See, I think when you mention Fed rate hikes, look at it this way, that as recently as March, we saw some collateral damage. A couple of banks, maybe not treated as systemically very important for the US, but all said and done, they were not small incidents. You saw a couple of banks, requiring Fed support and, kind of facing severe issues. I don't think we've seen the last of that. At least, take an example in India in 2018. Unfortunately, we saw the demise of ILNFS. Well, that happened in September 2018, but we saw the dominoes and the aftershocks all the way through 2019 or mid 2019 at least. So these things take time to travel through the system. We cannot be sanguine saying that, okay, it's behind us. So one is we have to watch for any kind of further collateral damage from the US. That is something one must watch out for. Uh, the second important thing, like I said, is that everybody seems to have got used to what is happening in geopolitics, but that is also something to watch out for. So I think next 3 to 6 months, it's not like everything is behind us, and I would be a bit watchful, and I would not extrapolate whatever has happened right into the near future.
Okay, long term, 3 years, 5 years, 10 years maybe also. How do you see the Indian markets vis-a-vis the world, both emerging and developed markets? And would you stick your neck out and say that India could be the best market to invest in hindsight if you see 10 years down the line?
Yeah, I mean, well, to put some perspective, unfortunately, we have held that status a couple of times earlier also in the past, and we have kind of sometimes we have missed certain opportunities. If you see 2010 to 2020, for the entire decade put together, earnings per share growth of Nifty companies was barely 3 to 4%. In dollar terms, for that entire decade, our earnings growth was practically zero. And hence, in dollar terms, for that entire decade, our stock market return was practically zero. So in the past, we have had opportunities, and in the past, we have kind of disappointed. But stock market enthusiasts never get tired of saying that this time is likely to be different. So there is a little bit more excitement or more to look forward to from here. And I'll tell you two or three things. See, one is that I do get the opportunity to interact with investors from pretty much different parts of the world who have been tracking India and who are investing in India. I can tell you that in the past, whenever people were investing in India, they used to invest in India more as part of a global emerging markets or BRICS or Asian equity or some global equity portfolio.
Yeah.
So bulk of the money which ever came to India came as part of a block. So if somebody put $100 in a global emerging markets fund, we might get some $10, $15, etc. But you know what? In the last 5 years, today, if you see as data stands, last 5 years, I think India is about 8% compounded return in dollar terms. But global emerging market as a basket in dollar terms is negative return. And that is because the largest component, which is China, has given a negative return in dollar terms for last 5 years and even longer actually. So what I'm finding is that a lot more people will probably realize that these baskets like global emerging markets or a BRICS is not working for them. And there will be a more direct, deliberate attempt to invest and single out countries like India and to invest directly. So my sense is that our prominence in the global scheme of equity investing is set to rise. That is already reflected in our weightage in MSCI emerging markets. It's also reflected in our global weightages in indices. But I think long way to go. So we are going to see a huge amount of interest and huge amount of influx in terms of foreign investment. One of the
Oh,
single biggest drivers of this is basically how much of global economic growth on a yearly basis are we contributing. Because pre-COVID, we contributed in any given year just like 3, 4, 5% of the world's incremental output. And if you see 2022, we contributed more than 20% of the world's incremental output. So, returns are always made on growth, and obviously, investment is made for returns. So, investment will chase growth. And in the foreseeable future, India is likely to be one of the biggest contributor to the world's incremental output, which means that we are likely to see a lot more interest in terms of attracting investment. And I think that we are going to have our moment in the sun.
okay, fair enough. Now coming back to the themes and the sectors then, and what to spot and where to invest really in the Indian markets, if at all. Recently, we've seen banks emerging as a consensus call. But is that the best sector to be in right now?
So, I can say one is say medium term, like short to medium term, and then the longer period. Now, if I speak with respect to your previous question, which is about India as an investment destination in the long
Yes.
term, uh, let's put it this way: that in the last 15 years, we've gone from being a poor country to a lower middle class country. If you look at per capita incomes, and it's quite possible that in the next 10 to 12 years, we might go from lower middle income to more like middle income. Right now, we're $2,500 per capita. Quite likely that we'll cross five, six, $7,000 per capita income in the next decade and above. So generally, and the good part is that we are not the first country who's witnessing this journey. World over, it is well known that when people get into a middle income kind of status, their top priority is to look better, to live better, and to plan for their future. That automatically leads one to believe that the entire space related to saving, investing, insurance, I think that is going to be a big beneficiary of rising per capita incomes, and that there'll be more and more people who will be in a position to plan for their future rather than meeting just their roti kapda makan. So that is one area. The second clearly is discretionary consumption. Last 15, 20 years, we've seen only staples, soaps and shampoos and toothpaste and stuff. But I think next 10 to 15 years, we are going to see more of, apparels and footwear and consumer electricals and gadgets and those kinds of things. So discretionary consumption and saving, investing, that is one space. This is, like 5 year out. But if you really ask me, in the next year or two, I think you're right. Banks definitely, resurgence in private sector capex, in investment, pickup in economic cycle, rising credit offtake, fantastic health as far as the banking sector is concerned. So all of this, they are in the pink of health. All of this enables them to participate in a big way in the next year or two. So clearly, banks is one. And apart from that, on a recent basis, maybe you look at relative valuations and attractiveness, then maybe pharmaceuticals, maybe mid cap IT. These are some other things to keep in mind.
Okay. How do you also see the outperformance of the broader markets of late? And do you believe that the bull run of 2020, 2021 that we saw post-COVID is perhaps back again with the same feel? And how do you really spot, the best stocks from the broader market space now?
Yeah, see, that is one of the things which encourages someone like me to believe that what is happening right now is sustainable. Because see, if you look at say 2022, even in 2022, Nifty made new highs. But the reality is that when you look at 2022, November 2022, when Nifty made new highs, the broad market like small cap, mid cap, Nifty 500, all of that was struggling. That up move was fairly lopsided, more in favor of PSUs, metals, commodities. Small and mid cap was underperforming. Whereas today, if you see, small and mid cap has started to outperform. It's keeping pace with the, large cap frontline indices. There are not practically no sectors or not, nothing of note, which is say way above its 52-week highs or way below the 52-week highs, right? So everything is participated in the last 3 to 4 months. If someone were to say, look at 1 year forward earnings projections, I think that also is in a good low to mid teens or teens kind of, earnings growth projections. So there are no big outliers or very big expected underperformers out there. So I think the breadth of the market, breadth of fundamentals definitely makes us believe that this is sustainable. And even if you refer to earlier part of the conversation, you must have noticed that good part of the risks that I cited were not to do with our domestic market. They were more to do with the external macro which troubled us last year and can trouble us some more even now. Or maybe like general election is once in 5 years is something to watch out for, but may not be a big event really.
Okay. At this point in time, would you advise investors to stay invested or book profits? How does one really decide that?
It's always a very, very difficult question, and there is no straight answer to this. Look, it's like this. Let's say you have made a lot more return than what you anticipated. So, see, long period averages, people should be happy with 12 to 15% compounded in equities. But if somebody has got a, amazing timing, made much higher than what they originally thought, maybe their asset allocation needs to be revisited, because for your goals, for the return expectation, and for the risk appetite that you possess, let us say you should have been 50% equity, 50% debt. Now
Yeah.
you can imagine that in the last 3 to 4 months, the equity proportion might have gone up a lot vis-a-vis what it should be. So first is always that when you make much higher return than what you thought, and if your asset allocation has kind of strayed away, then you should certainly revisit and take some off and rebalance your portfolio. That is one. But for the existing investors, it's lesser of a quandary. I think the difficulty is for someone who wants to start investing now. And
Yeah.
that's where there are no easy answers. So if somebody wants to start investing now, I don't think you should jump in headlong thinking that that train or bus is being missed. You should, ideally speaking, put money into a liquid fund or ultra short-term fund, and then drip that money over the next 6 months into equity. Month on month or fortnight on fortnight. In the industry parlance, we say do a systematic transfer. So park money into a liquid fund and then drip it into equity over the next 6 months. I think that will be a good thing to do.
Okay, so say if a fresh investor has 1 lakh rupees to deploy in the markets, how does one do that?
So yeah, so either one goes to a hybrid fund, which is like a balance advantage fund, because these funds they will always be very mindful of equity versus fixed income relative valuations, how much to put in equity, how much to put in debt. They run in a kind of programmatic fashion. So let's say if we manage a balance advantage fund today, it is actually somewhere in the vicinity of 50% equity and 50% in fixed income,
Yeah.
right? That's more reflective of fair value, but that's where it is actually. So if you put money into such a fund, it will put 50% equity, 50% debt. And in the next 3 to 6 months, like I said, if there were to be a correction, then it will start moving your money from debt into equity. That is one way to get started. The other way is what I said earlier. You put that lakh rupees into a liquid fund and then give an instruction that over the next 6 months, every month, some 15,000 rupees get switched into equity.
Okay. And one last question that we always get asked on our platforms, and I have to ask you this from our viewers' perspective. How does one really identify multi-baggers for one's portfolios?
So see, whether it is professional life, whether it is investing, whether it is sports, everybody loves to take that one big swing, right? And you must, make that attempt. It's your right to take a big swing. But what happens in stock markets? The fact is that chasing multi-baggers and being very deliberate about chasing multi-baggers,
Yeah.
I think there is no one way to do it. I mean, it is more likely to land you in trouble. So I would say that for someone like me or for our viewers, I think on an average, what a average investor should do is to look to do slightly better than the market, right?
Okay.
It's not, you cannot be deliberate about chasing multi-baggers. Well, yes, there are very many renowned investors. Like if you ask us in terms of our investment philosophy, we have a science, we have a process. We ourselves have a 30-member team dedicated to identifying winners in the small and mid-cap space. But ultimately, we run a broad, diversified portfolio, right? And I think a portfolio approach is what holds people in good stead over the number of years. If I were to bet a big amount of money on few stocks thinking that some of these might be multi-baggers, it's a good chance that I might end up with zero, right? So I think that it's not an ideal approach to be deliberate about chasing multi-baggers. I think on balance, people will do much better if they go for a broader diversified portfolio, and then they expect that if the benchmark does say 12% over a period of time, then a good mutual fund should do say 2, 3, 4, 5% over the benchmark. So a consistent above average kind of approach will be more sustainable rather than trying to take big swings, which can land you on the other side of the curve altogether.
Fair point. Well, on that note, many thanks, Mr. Somaiyaa, for being with us on the show, sharing such wonderful insights for all our viewers. Always a pleasure speaking to you and getting more insights about the markets. And here's hoping that we can have many more conversations going forward as well to get more insights onto how you as a professional also build portfolios, and then the conversations can flow in from there as well. How do you differentiate between your own personal and professional portfolios too? So all of those insights will also be welcome if we can have you for many more interactions going forward too. All right, many thanks for being with us.
It's my pleasure. Look forward to it. Thank you.
All right, and with that, we wrap up this special edition, but do stay tuned onto Business Today TV to catch all the updates from the world of business and stock markets. Don't go anywhere. Don't forget to subscribe to this channel and also continue to engage with us on our other social media platforms as well. Until then, many thanks for tuning in.